loan. So bridge loans are not loans to finance bridges going across the San Francisco Bay. Bridge loans are a loan that will assist your buyer who is selling a home and buying another home but has not yet closed escrow on the home that they are selling. And it is a great opportunity to deal with the challenge that we run into on the regular basis when somebody has a home to sell and they want to buy another home. And I'm going to oversimplify it for you, even though most of you on this call are realtors. You understand this, but for any buyers who are also going to be watching this, I want to make it clear. You have 3 ways that you can buy a home when you currently own a home. The first way is sell your current home first, which is great. Now you've sold that home. You're homeless unless you get a rent back from this buyer of the home that you from the buyer of the home that you're selling, might let you stay in the house for a period of time. The benefit is you're now non-contingent. You are not contingent upon the sale of a home to buy the next one because you already sold your current home. The second scenario is to buy and sell at the exact same time. So you find a seller who's willing to sell you a home, but will wait for you to find a buyer for your home. Or you find a buyer willing to buy your home, but willing to wait for you to find a seller that will sell you a home. And the sellers are less likely to accept your offer simply because you're having 2 sets of transactions that have to close, yours and the person buying your home, in order to successfully close on their home. And that doubles the chances of a problem. So in a highly, highly competitive market like we're in right now, that's tough to come by. It does happen, but it's really tough to get an offer accepted under those circumstances. So the third scenario is if you purchase a new home first and then you sell your old home after. The problem is twofold. First of all, you have to qualify for the monthly payment on both houses because you still own the house you used to live in at the same time as you buy the new house. And equally or more important is, where do you come up with your down payment? Because most people's down payment come from the sale of their current home. That's where the bridge loan comes in. The bridge loan provides you a portion of the equity in the home that you are selling or will be selling, and you can use that towards the down payment of your new home before you've sold that old home. It's going to make you able to remove contingencies and put you in a much better position to be successful in purchasing that home if you cannot find a situation where you can find a buyer and a seller where you can close concurrently at the same time. So how does it work? Well, first of all, I'm going to give you a basic overview and then I'll talk about some of the details. The basic overview, this is perfect for a client who has a sizable amount of equity in their home. There's a client that I spoke with last week. He and his wife own a house that's worth about $400,000 and they are owing about $200,000 on that house. They want to sell that house, take about the $170,000 they're going to net out of that home and put it towards the purchase of about a $450,000 to $500,000 home that is an upgrade for them. They want to move out to the country and have a country property. I explained to him the 3 scenarios. They definitely don't want to sell first, and they don't have the money for the down payment. If they wait and keep both homes, they don't have the money for the down payment. So ideally, he wants to find a contingent situation where he can go buy a home contingent upon the sale of his current home. I explained that he can use the bridge loan to have a fail-safe. He can write an offer without being contingent on the sale of his home. Now, once he gets an offer accepted, excuse me, he can absolutely go list his home for sale, try and find a buyer for his home, and try and close them both at the same time. Nothing says you can't have a home that you're going to sell. You just can't be canceling the contract or delaying the closing if the home you're trying to sell doesn't close in time. Now, I'm not your broker. I'm not a car attorney. I'm telling you what my understanding of the guidelines and the rules are. Just because you want to sell your current home does not mean you have to be contingent upon the sale. It just means, just like if you have to get an appraisal on the home, but you release the appraisal contingency, it simply means you cannot cancel and get your earnest money back if the transaction falls apart due to you not selling that home. But that's the beauty of the bridge loan. For this client, if he found a buyer for his home, and if the buyer was, something happened and the deal fell out of escrow, then he can still buy the new home by using the bridge loan. And I can give him between $50,000 and $100,000 of his current equity to put towards the purchase of the new home. And then he gets his house back in contract with somebody else and gets it sold very, very quickly, ideally before his next mortgage payment is due on the house he's selling. I gave him this scenario because I want you guys to understand how this is going to play out in real life. I said, look, if you wrote an offer right now and you were planning on closing at the end of June, if you could sell your home and they both close at the end of June, great. But if it falls apart, if something happens, or if there's a delay in the sale, in the closing of that transaction, you can still close escrow on your current home. Your first mortgage payment on your new home is not due until August 1st. That gives you an extra 30 days between the June 30th closing of your new home and August 1st when you have to actually make 2 mortgage payments. So he's got an extra 30 days to get his home sold without having to worry about making 2 mortgage payments. It definitely is risky, and he needed to be aware of the fact that what if his house didn't sell? He's got to write a second check. He's got to write a check for 2 mortgage payments at the same time. But the chances of that happening in this market are pretty slim. And so that was a chance that he is willing to take. And that's where the bridge loan comes into play. And now that you've got that story, I'm going to use that story to help understand how these details work. There are 2 scenarios. We've got the debt qualifying bridge loan and the easy close bridge loan. And the difference between them has to do with how the debt to income ratio is calculated, but it's determined based on the sale status of the departure residence. The debt qualifying bridge loan, I'm going to use the example of the client we just talked about, is if he had listed his house for sale, or he decided, you know what, I'm not going to list it for sale until after I get moved into the new one. I want to make it clean. I don't want to have buyers walking through, or prospective buyers walking through the house while I'm living there. No problem. Then we use the debt qualifying option. The house has to be listed for sale before we close escrow, but it could be right at the end, right before we close escrow. We're going to do an appraisal on the property you're selling, and you have to list it for within 10% of what our appraised value is, because we want to make sure that that house is going to sell. We don't want to be stuck with a bridge loan on a house that you guys are overpricing in hopes that you're going to get that high price, because our worry is we're going to be stuck with a bridge loan somebody cannot pay off. We do have to count the monthly payments of the bridge loan and the home they're moving out of against them, so their debt to income ratio has to qualify. And I'll loan them up to 70% of the value of the home they're moving out of. So for him, his house was worth 400. 70% of 400,000 is $280,000. He owes 200. So I could loan him $80,000 as a bridge loan. The bridge loan has to be a minimum of 50 and a maximum of 100. He fits right into that sweet spot. I could loan him $80,000 as a bridge loan, and all he has to do is list his house for sale prior to closing escrow on this purchase, and I can loan him the down payment. You make 0 payments on the bridge loan. Yeah, no payments. So even if he ended up making a payment on his old house and his new house, he's not making a payment on the bridge loan. So that a payment is included as interest over when you repay the loan. So that's the debt qualifying option. Again, guys, if you have questions, feel free to paste those questions or post those questions into chat. If you're on Zoom, if you're watching on Facebook Live, I'll catch your questions later. The second option is our easy close option. That scenario is when, for the example with this buyer, he went into escrow on a buyer to buy his home. He's not contingent upon the sale of his home to buy the next one, but something happens in the end and his buyer's closing is delayed. Maybe their money got delayed a little bit. Maybe there was an issue with timing and their closing disclosure's not out yet and they can't close on time. But if the home that you are selling is in contract and the buyer has released all of their contingencies, then we can do 2 really amazing things. We can ignore the monthly payments on the home that you're selling, because in our opinion, you're going to be selling that home. It's in escrow. There are no contingencies. Therefore, we can ignore that monthly payment on the first mortgage you have on the house and on the new bridge loan, second mortgage you're putting on the house. And I can loan you as much as 80% of the value of the home, because I know that we're that much closer to this home selling. It's not just listed, but it's in contract. I know what the sales price is, and I'll give you 80% of that as a grand total between your current first and the new bridge loan. So those are the 2 basic options. I'll help you navigate the waters on which direction we're going with your buyer. but it gives us a lot of flexibility, especially if they end up in that position where they're trying to buy a house while selling their house, but they do not want to write their offer non-contingent, or they don't want to write their offer contingent. The bridge loan becomes your backup plan. It becomes your contingency plan if the sale of the home doesn't close in time for when you're trying to buy the new home. That's the value of this product, and it is a game changer for your ability to help your buyers get offers accepted in today's crazy, crazy market. So let me cover some other details about both of the loan, about really both the bridge loan in general. So regardless of whether you're doing the easy close or the debt qualifying option, these are some details about the bridge loan in general. It's a 4-month loan. So this is not a long-term loan. It's a balloon note that's due 4 months after we start because we want the home to be sold. The idea is you're selling the home and you're selling it quickly. It is a 5.99% interest rate. Now, I got to tell you, that's pretty good. I've had a lot of clients who go out and get home equity lines of credit on the house they're going to sell in order to kind of accomplish the same thing. But 2 problems with that. The home equity line of credit, you have to make a monthly payment on. The bridge loan, you don't. The second thing is a lot of home equity lines of credit are higher than 5.99%. So I was actually really happy when I found out the rate on this is 5.99. There's a 1.5% origination fee. On $50,000, that's $750 as an origination fee. So it's not very much money, but it is added to the loan, or it's actually the first draw. So if you're getting a $50,000 bridge loan, you're actually only going to get $49,250 because we're keeping the first $750 or 1.5% as an origination fee. No monthly payments are made on the loan. Here's the biggest key for me, guys. We are not in the business of doing bridge loans. I don't get paid for doing bridge loans. I am in the business of doing primary mortgages. We are only doing the bridge loan if your buyer is using me for financing on the new purchase. So they must have Summit Funding as their lender. They must have John King as their lender. Now, other Summit Funding loan officers can do this too, but you want to use me. So they must have John King as their lender, and it must be a conventional loan. So we cannot do an FHA if their new loan on the new home they're buying is FHA, VA, or jumbo. We cannot give the bridge loan. It has to do with guidelines about FHA, VA, and jumbo that won't allow us to do the bridge loan. So as long as they're doing a conventional loan, then we can do the bridge loan for them. Again, it has to be Summit Funding as the lender on the new house in order to do the bridge loan on the old house. 680 minimum credit score, $50,000 to $100,000. Couple of details at the bottom. No LLCs. House can't be owned by an LLC or in a trust. So if it's in a trust, we'd have to take it out. No partnerships. No UCC filings. That one's kind of ugly. UCCs are becoming a thorn. A lot of solar companies, when they put solar leases on your home, they add a UCC filing to title. And that technically is considered a second mortgage in the eyes of conventional loans, which would mean my new loan would be, the bridge loan would be a third mortgage. We won't do this as a third mortgage. So you can't have an existing second mortgage and you can't have any UCC filings on the property, okay? So questions about the bridge loan, feel free to post them into chat. I'm gonna summarize again real quick about the bridge loan and then I'm gonna jump into the construction loan for you. Bottom line, guys, the bridge loan is a contingency plan for your buyers that don't wanna write their offer contingent on the sale of their home, but they're planning on selling their home either while in escrow and hoping to close concurrently without being contingent, or somebody who wants to get their home listed right at the end of the escrow period so that they can maybe have more time to get their stuff moved out and not have to do a double move. But the bridge loan is a beautiful solution for that. All right, so I'm now going to dive into the manufactured home construction loan. This is a brand new product for us and I'm super excited about it. And instead of you listening to me drone on about this product, I'm actually going to play a quick video. So hopefully
Summit
you'll be able to
Funding
hear
Inc. introduces
sound.
our one-time close program, a program.
Oops, I just scooped that up, hold on.
Summit Funding
Hear the
Inc.
sound? I can't
introduces
hear the
our
sound.
one-time close
Can
program,
somebody post in
a
chat and tell me if
program
you can hear the
designed
sound on
just
this
for
one?
manufactured homes. Whether you're a dealer, realtor, or buyer, Summit Funding is here for you every step of the way. As one of the top mortgage lenders in the nation,
Anybody
Summit
hear the
Funding has
sound?
developed a special team of professionals that work hard to arrange special financing so you can purchase your very own manufactured home. Typically, manufactured construction loans are financed through chattel loans. With a chattel loan, the home is not permanently affixed to the property and does not have a permanent foundation. Therefore, the home is not considered real property and can only be financed through private lending resources. Chattel loans typically offer shorter terms with higher rates, and standard mortgages cannot be used. You cannot claim homestead exemption with a chattel loan, and you will pay personal property tax and property tax. So what sets Summit's program apart from the rest? With our one-time close program, you can finance your home using a standard 15-year or 30-year fixed loan to combine financing for the lot purchase, construction, improvements, and permanent mortgage. Summit offers competitive rates allowing for lower monthly payments. You can claim homestead exemption on your property taxes, and you will not pay personal property taxes on the home. How do these two options compare? If you were to finance a $250,000 home using a chattel loan through private financing, your interest rate would be around 10% over a term of 22 years. Your closing costs and fees would total to $12,500. Your total mortgage payment, including taxes and insurance, would be $2,950.85 per month. By using Summit Funding and financing this $250,000 home through a government-insured or conventional loan, your interest rate would be 4% over a term of 30 years. Your closing costs and fees would total to $11,000. Your total mortgage payment, including taxes and insurance, would be $2,075.88 per month. By financing this $250,000 home through Summit Funding, you would save $1,500 in closing costs. You would also save $779.94 per month on your mortgage payment. This is a savings of $9,359.28 each year, and a total savings of $192,792.88 over the life of the 30-year loan. By using our one-time close program, you will not only save money on closing costs and your monthly mortgage payment, but you can also purchase your home for less money down. Through chattel loan financing, typically the buyer must purchase the home, purchase the lot, pay to set the house upon the foundation, and pay to hook up electricity and sewer to the home. Although some of these items can be financed, it can cost the buyer upwards of $100,000 in cash. With Summit's program, you can put as little as 3.5% of the purchase price down. For example, on a $250,000 home, the total cash needed for your 3.5% down payment is $8,750. In addition to the low down payment, closing costs can be paid for by the dealer if negotiated into your contract, and if you already own your land, you could close on your home with zero money out of pocket. So, how does our new one-time close program work? Step 1. Meet with a Summit Funding loan officer to get pre-approved for your home loan. Step 2. Meet with a dealer, choose your new home, and find a lot. Step 3. Your paperwork is reviewed by your Summit loan officer. Once we receive the builder contract, the home builder goes through our approval process. Step 4. Your loan is structured, reviewed, processed, and underwritten by Summit. Step 5. Once you receive your approval letter and commitment agreement, you will sign all documentation. Step 6. Then the construction loan closes. Construction begins on your new home. Step 7. Construction is completed. Here, municipality issues a certificate of occupancy, which certifies your new home was built per building codes and other laws. Step 8. Your loan is finalized and modified into permanent loan terms if necessary. Additional documentation may need to be signed. Step 9. It's time to receive your keys and move into your brand new home. With our one-time close program, your homeownership dreams are within reach. Purchase your manufactured home for less money down and save big on monthly mortgage expenses at Summit. Reach out to your local Summit Funding loan officer to get.
All right, guys, thank you for, hopefully that helped instead of listening to me. For some reason, I could not hear the audio from that video playing. So
Summit
you guys
Funding
can hear it,
Inc.
and that's all that
introduces our
matters.
one-time
But
close
I
program,
appreciate your
a program
patience.
designed just
Now
for
it started again. Cool, now it's gone. All right, so I now want to go over basically some details of what to understand or how this is really going to work. You are purchasing land. You are we're financing the purchase of the land. We are financing the preparation of the land. We're financing the building of the manufactured home, and then we're financing the placement of that home on the lot. So everything added together, that comes up to what I call your total acquisition cost. From your total acquisition cost, you are putting anywhere from 3.5% to 5% down, or even zero down payment, depending upon the loan program. So this is a traditional VA, FHA, or conventional loan. So VA 0 down, FHA 3.5% down, conventional is a 5% down payment. What I'll tell you, I talked to some people who do these on a regular basis. They said best practices is if you're helping a buyer find land that we're going to make this work for, they need to pick out the land and get a 90-day contingency period to do their due diligence, because they've got to get all of the plans and specs for the manufactured home, for the work that has to be done on the lot, any utilities that need to be run out to the lot, and confirmation that they can get the utilities they need, and then confirming what the permit process is going to look like and what the costs are going to be on those. Most buyers are not going to be willing to purchase the property in cash or take the risk of buying the property, not knowing they can get all of that stuff done. We are not going to finance the purchase of the property until all of those things are done. So either your buyer buys the land in cash, and then I can help them do all the rest of it, or it's a long escrow. And during that escrow period, we're getting everything lined up from the manufactured home dealer. We're getting everything lined up with the county for permitting, or at least what the permit process is going to look like and costs for that. We're getting the contractor lined up that's going to be doing the site prep and the installation at the end. So that's why we recommend a 90-day contingency period and 90-day close of escrow realistically. Here's the deal. The average build starts at $250,000 to $300,000, and that's not including the land price. So you got to figure out where this buyer is looking at buying and what land is going to cost. This cannot be in a park. These aren't chattel loans, so you have to buy land, and there cannot be another home on that land. So if you buy a piece of land that already has a home on it, you cannot use this to build a second home. It has to be bare land, because we will not pay for the removal of a home or the tear down of a home. It has to be bare land, and that's the only option you have to utilize for this program. 680 minimum credit score, no jumbo, no down payment assistance. Your rate is market rates. Once the home is attached and it's real property, then it's market rates. Manufactured home rates are a little bit higher, maybe 0.5% higher. So we're in the mid to high 3% range, which is fantastic for a manufactured home loan. During the construction period, the draws are charged at 8.99% interest, but no payments are made on that. The cost of the interest, kind of like the bridge loan, the cost of the interest is wrapped into the cost of the loan. And when it is modified to the permanent financing, once the home is finished and we have a certificate of occupancy, then the entire amount of the loan, including the interest due on the construction portion of the loan, is now turned into the new principal balance for the long-term 30-year fixed rate loan. It can only be used for owner-occupied properties. And I said a minute ago, you can only do one unit on the lot. So you cannot already have a home on there. And the buyer must own the land. You cannot finance, I cannot finance the installation of a manufactured home on land that's owned by grandpa. Now, if grandpa wants to split the lot and get a legal lot split, and then you own the other land that has been split off, great, I can do it. But you cannot do it on land that is owned by somebody else. If grandpa says, hey, I got this piece of land and I want to add your name to it, grandkids, great, we can do it. But you as the buyer must also be the owner of the land. All right, so I covered a lot in the last 25 minutes. I am super excited about both of these programs. I think there's huge opportunity. The bridge loan, I think, is a game changer for people who are having a home that they have to sell. They don't want to have to write an offer that's contingent upon the sale of that home, and it puts them in a position where they can get the money from the sale of their home in advance, at least a portion of it, to put towards their next purchase. And again, I think half the time they're never going to need the bridge loan. The bridge loan simply serves as their fallback position. If they go to sell their current home and it doesn't close on time, we can use the bridge loan so that they are not breaching the contract on the purchase of the new home when they wrote that contract, not being contingent on the sale of their current home. And the one-time construction loan for manufactured homes, super awesome opportunity. I think we're going to see this more, people who want to move outside of town. Clearly, there isn't much land in the city, but I think this is going to be more utilized in the foothills. I'm seeing a lot of interest in this product in the foothills. So if you have buyers that are looking up there, that might be a great opportunity. The process is going to take probably about 4 months from start to finish for the home to be built, manufactured, and installed. So they need to be aware of that. And you're going to add that to what could potentially be a 60 to 90 day escrow. Once escrow closes, now it's about 4 months from that time until the home is built and placed on the land with the final certificate of occupancy. Definitely want to make sure your buyers are prepared for that fact. Gang, if you don't have any other questions, I really, really appreciate your time. Look forward to taking great care of you. And if you have any questions, feel free to post them on chat. Otherwise, enjoy the rest of your Thursday, and we'll talk to y'all soon. Bye-bye.